2, 1. Right, I think we're live, ladies and gentlemen. Welcome to those of you on the virtual stage, and of course to those of you out there listening and watching. Delighted to be back talking about Africa. It's been a little while since we've had a Pan-Africa chat about bond markets and financing, and very glad to be doing one today. And we've got an excellent group of people here to help us unpack that subject, or that range of subjects. So I'll just introduce them very quickly. From the African Development Bank, not from the funding side, but from the Sovereign Risk team, we have Benjamin Akam joining us. Nicole Kears is also joining us. She's Principal Legal Counsel and Head of Sovereign Finance in the African Legal Support Facility, which is an organism related to the African Development Bank, but is not the African Development Bank. We have Gatien Bong joining us from Rothschild & Co., obviously a firm known for, well, I guess probably centuries, advising sovereigns all over the world. And Gatien specializes in Africa and other emerging markets. Thabo Letlaka joins us from South Africa, where he is the Deputy Chief Investment Officer for the Eskom Pension Fund. Saad Sheikh is a partner at Enco Capital here in London. And he might tell us a little bit more about that, but they are London-based and specialize in Africa. You buy bonds and equities, and do you have other investment? Well, don't tell us yet, because I'll just finish introducing. Kolawole Owodunni is the Executive Director and CIO, Chief Investment Officer for the Nigerian Sovereign Investment Authority, the Sovereign Wealth Fund of Nigeria, which obviously, among its other responsibilities, manages the country's essentially oil hedge. And Admasu Tadesse joins us from, you're in Nairobi, I guess, Admasu?
In Mauritius, right.
Oh, you're in Mauritius right now, okay. He's the Group President and Managing Director for the Trade and Development Bank, which is sometimes known as the Eastern and Southern African Trade and Development Bank, isn't it?
It is, yes.
It is, but just to sort of locate your sphere of influence. So
but we're now in West Africa, Christopher. We're in Ghana, we're in Senegal, so we're continental in many ways.
Well done. So all those countries have become shareholders in the bank now?
Yes.
And the bank, just as a prelim, does finance itself through international bond markets, also international syndications, syndicated loans, that is, sukuks. And we'll talk a little bit about sukuks in the context of the very recent deal done by the Republic of Benin. But Saad, I'm going to come to you first, and just to sort of a little bit of background. I mean, the case for emerging markets investment generally, which is very much back on people's agenda, I think, for this year, after a period of being somewhat diminished interest among portfolio investors in EM, as we call it. Obviously, there's a hope for yield. The interest rate environment is partly driving that. But I want to just go back to the fundamental case for emerging markets investment, which is similar in many parts of the world, but in the context of Africa is based around demographic change, is based around the rise of urban movement from countryside to urban, based around the rise of a more educated middle class, so new consumers coming in to the economy, coming into the marketplace generally. I mean, things like schools, for example, huge developing sector in much of Sub-Saharan Africa, as middle-class consumers want to educate their kids. And we mustn't forget technology. We must always remember technology, which, of course, again, in the African context, has been in the forefront of driving financial inclusion. Very well-known stories that people know about M-Pesa and so on in Kenya. So, but Saad, as you view the world and you look at investment opportunities, look for investment opportunities, just give us a sketch of whether you think those fundamental arguments are still valid, how important they are, which parts are more important than others, and put it in an African context, just in a minute or two, and then we'll ask others to comment. So over to you.
Thanks so much, Christopher, and a pleasure to be here. Absolutely. I think emerging markets are the place to go. We have seen the stagnation in Europe. We are seeing some sort of a turmoil coming from the West. So the markets to really kind of put safe capital and see development out of is definitely the emerging markets. I'll talk more about Africa because that's the remit that we have as Enco Capital. We are African owned, $1.4 billion total AUM, deploying capital exclusively across Africa, but across a number of asset classes. To your earlier question, Christopher, we have a debt hedge fund, long and short. So we'll buy bonds, local currency, euro bonds, etc. So very well entrenched in the macro. We then have a private equity offering, looking at pre-IPO structures back in 2014. Now looking at more majority stakes, because I think the way to create value is by being more hands-on. Then a private credit strategy, predominantly looking at growth capital to otherwise capital-starved businesses. And you'll be surprised how many businesses are capital-starved, despite how large they are.
Sorry to interrupt, but just whilst you're telling us a little bit about the firm, which is very interesting, your investors, are they on the whole people who are very well experienced in Africa, or do they come to you because you're well experienced in Africa and they want to take a new look?
Yes, it's a great question, Christopher. I think more the latter than the former. There are a few players who know and understand Africa well. Some of the local pension funds, but a large the majority of our investors are otherwise not African focused investors. They will have a strategy for something that we would do, but would come to us because of our African experience, our boots on the ground. We also have local asset managers on the ground managing both debt and equity liquid platforms in local currency. So that depth that we offer investors is parallel to none. But then if you kind of take that out, why we are in Africa, because for the last 5 years, people are like, hey, that must be restrictive if you're trying to raise money only for Africa. And to be honest, it is. But there is a thesis within the firm that Africa is the next big thing on the continent. We've heard, or in the world, to be honest, but we heard about Africa rising in 2012, and then we saw very little, and that all fizzled out. But we've got to look at the macro factors, the underpinning building blocks. And Africa at this point in time, with a weaker dollar, with stronger fundamentals, with a step change in currencies and stabilizing not only macro environments, but fiscal and monetary policy, there is a good, strong drive for development in Africa. And I think African leadership has also evolved to realize that looking to the West is not always the solution. And sometimes solution is much closer than they think. And this is why we've got a few players in the market on this conversation as well. They are so vital. Where local capital is of paramount importance.
Absolutely. And we're going to talk specifically about local capital markets, local bond markets, local currency bond markets. But let's turn, Tabo, you were just about to say something, so I was going to turn to you anyway.
Perfect.
Which is good. But I was going to say, one phrase we're going to hear probably more than once during this conversation is African capital for Africa. So, Tabo, that obviously leads me directly to you, because you are the Deputy Chief Investment Officer of a very large pension fund in Africa, $10 billion fund.
Yes, I just did the maths not too long ago. Actually, about 16, but just for ease of mathematics, I'll say about $15 billion.
All right, that's the size of a chunk. So, how much of that do you invest? Obviously, you invest some of it at home in South Africa.
Perfect.
How much of that do you invest in Africa ex-SA?
Perfect. Let me just kind of put it in a nice bow. About 65% firstly local, so that's all SA. So let's say 2/3 local, 1/3 offshore, including Africa ex-SA. Africa ex-SA makes up about 4% of that, and mostly we've been, maybe for the last 10, 15 years, we've been in listed equity, and that's been interesting. The last 2 years, very strong performance. So quite happy with that. But really, I'd say the years before that, middling to poor performance, I think, Africa XSA equity. We then kind of relooked at our strategy and thought, okay, well, let's actually diversify that investment a bit. And then we invested in fixed income. And we do so really in two kind of ways: listed fixed income, which we manage internally, and that really looks at Euro bonds, and specifically really sovereigns, and then a little bit of a sleeve in private credit as well, which actually is how I think I met Enko and Saad, as we're looking for a potential manager on that front. And so that's roughly the story. Let's say about 4% in Africa XSA. And so far so good. I think the last 2 years have been good, both in equity and in fixed income. So our principals are happier as that story turns around. And I just totally agree with you there, Christopher, that in our minds we think we want to invest in the continent. We want the continent to do well. We ask ourselves questions often about whether that's perhaps too narrow. We should broaden that and make it not only Africa XSA but potentially even frontier markets. And so we've started thinking of Africa within the context of frontier markets, but nonetheless remain invested.
So looking at some of the kind of further reaches of Asia, Latin America, things like that.
Yes.
I mean, if I may say so, 4% doesn't sound like an enormous weighting. Do you have plans to increase that allocation?
Yeah, really good question, and one that is hotly contested internally. At this point in time, I think essentially anchored to the fact that performance has, as I said, in the past been middling to poor. We've landed on this about 5% level as a level of comfort, and at a slightly underweight to that level. We continue to look, and we shall see how that goes. But in general, if I just look forward, we like emerging markets. We really do think that the next few years structurally are going to be positive for frontier markets, Africa XSA, emerging markets, and so we'll probably invest a bit less in developed markets.
And of course, it's fair to say that Africa XS, I mean the SA part of it, obviously a lot of those, from the equities point of view, a lot of those companies have big exposures to XSA Africa and are operating there and driving their profits from there. So the money is indirectly going in the same direction.
Sorry, one last thing, actually, Christopher, to now interject and disrupt you. I also actually be incorrect not to mention that my private equity colleagues also invest in Africa. So apologies for that, but there's also a bit of a private equity story as well. So not only listed, but also for many years, over a decade in private equity as well in Africa. XSA.
All right, good. Well, let's turn to another investor, Kola. Sovereign Wealth Fund of Nigeria. You've heard my little sort of introduction. Is the fundamental case for investing in Africa still the sort of classic EM case of demographics and education and urbanization and technology? Do you see those as prime drivers? What else do you see as driving? And I'll ask you a bit more about your portfolio as well in a moment.
Thank you very much. I think everything you said is still very relevant. One thing that has cropped up of late is climate, the focus on climate and climate resilience, and also energy security. And so alongside everything you've said, I think the other things that we in Nigeria have realized is very important across the African continent is, climate resilience for our infrastructure, climate aligned infrastructure, and also energy security for ourselves and our geopolitical zone. And so these are themes that we are investing very strongly across, both in Nigeria and across the African continent. Like Thabo, we also have, a large domestic capital base. So we have the Nigeria Infrastructure Fund, which is about 43-45% of the NSIA, is purely focused on commercially viable infrastructure in Nigeria. But then we have a Future Generations Fund that is about another 43% that is global. Of that, I would say about 25% of that is in Africa, across equities, fixed income, and private equity as well. And so what we are seeing is good opportunities on the continent, good opportunities in sectors such as, renewable power, toll roads, and critical infrastructure. We also see opportunities for in consumer goods. And that is typically done through our private equity sleeve.
And staying with you for a second, Gola, there's obviously for quite a few years now been a large fintech story growing in Africa. Do you have a part of perhaps your PE fund that invests specifically in that?
We do, yes, and we have seen strong returns. But beyond strong returns, there has been significant impact, both locally and regionally. And we are seeing some of these fintechs expand beyond the shores of Africa, actually. Quite pleasantly. But these are strong growth drivers, and they've actually significantly encouraged financial inclusion as well. With ancillary impacts of that.
I mean, M-Pesa is almost the kind of original financial inclusion driving fintech. I mean, going way back to, I don't know, 2007, 8, and it really was a ground up thing, wasn't it, in Kenya? Because Safaricom noticed that people were using phone credits as currency. And then Equity Bank got involved, and then the whole story took off. But I mean, the classic financial inclusion story that I remember from chairing conferences on the very subject a few years ago was the kind of microcredit thing, where somebody can borrow $10 in the morning, buy a box of oranges, sell them at the side of the road, pay back $10.50 in the evening, keeping $9.50 profit. I mean, that is still part of the fundamental case. I realize it's a great deal more sophisticated than that, but that is part of the financial inclusion story, I think. Gatien, let's turn to you. Obviously, you have, like many people here, you have a pan-African point of view. What do you think of what these guys have said so far? And if you had to, you were talking perhaps to a client in the US or somebody who didn't know much about Africa, and you had to pick 3 good reasons to invest in Africa, what would they be?
That's quite an interesting angle indeed. Let me start by the first part of your question, and I think I concur with a lot of what has been said so far. To start by the sources of financing in Africa, I think indeed the rising trend of having more domestic and regional financing has been very substantial in the past couple of years, while at the same time seeing a continued ability for sovereigns to continue and fund themselves on the Eurobond market. And I think it's quite interesting to see the two dynamics unfolding in parallel, with also, which I think is very much end 2025 and 2026 trend, to seeing that a number of private deals have appeared and have been increasingly viewed as attractive by sovereigns. The second trend I would note, looking backwards at the final months of 2025 and forward in the next couple, is that there has been, for the first time in quite some time, a series of upgrades in terms of credit ratings within SSA, while at the same time some zones have been facing very challenging liquidity situations. And I think that the hysteresis and the difference in assessments of different zones of Africa has been very substantial in the past couple of months, which in turn allows for a very clear need for debt sustainability analysis to be looked at in the fundamentals as always, but probably in a more acute fashion than a couple of years ago when the access to liquidity was relatively easy. On your latter question, look, I think there are many reasons for people to invest in Africa, and you mentioned quite a few already. I think that the one I would add from a fundamentals perspective is also the ability on a forward-looking basis to continue domestic revenue mobilization, and therefore to have a much wider base, and therefore an ability for the investments to be performing in economies that are growing faster than what people expected a couple of quarters ago. I think in October, the IMF revised upwards their growth projection forecast for SSA, and that's a trend which has been very positive and has a lot of more silver linings than what you can see in other continents.
I should just say, point of terminology, SSA, of course, often in our universe means sovereign supranationals and agencies. In this context, it means mainly Sub-Saharan Africa, although we are talking about SSAs in SSA, just to make that clear. I don't know who would like to answer this question. Admas, I might turn to you because you might know the answer. There's a question in from someone in the audience, unfortunately anonymous, but this person wants to know what's the total sovereign debt of the continent and what is its trajectory. Now, you could take that any number of ways, but let's assume for a moment it means offshore debt, so hard currency debt. I mean, I can say that in terms of straightforward Eurobond issuance, and remember, Eurobond doesn't mean something to do with the euro, it means something for a currency outside its natural jurisdiction. So as often as not, most of the time, in fact, in dollars. In 2025, there were $16 billion worth of Eurobonds issued by out of Africa, busiest year since 2019. But Admas, do you happen to have a figure to hand for the total external indebtedness of African sovereigns?
Yeah, well, I think, Christopher, it might be easier to reflect this in terms of the ratio. Debt to GDP is usually the metric that is often used to describe indebtedness levels. It's not the only one, but it's one of the leading ones. And it's been hovering around 65%, but it's kind of come down a little bit by a couple of percentage points. And the trajectory is downwards, which is good news. Clearly, the sort of rising indebtedness problem of earlier years is no longer with us. There is consolidation. There has been quite a bit of discipline this past few years. It's been negative. There's been actually negative net outflows from the continent. So the stock of debt has stabilized and is actually coming down. So that's the good news. But in addition to that, you actually have continued growth that's coming in. And some of the countries that had been in distress have stabilized, and the outlook for their debt carrying capacity, countries like Zambia, Ethiopia, the outlook is actually better than it's ever been before. So,
because in both those examples, they've been through pretty rough times in terms of.
They were part of the common framework. They signed up for the debt restructuring. They did default, but their numbers are looking quite bright now, and expectations are quite positive.
I mean, Ethiopia. Going off piece slightly, I don't know how much experience any of you has in Ethiopia, but it must be the biggest country that no one ever hears about. I mean, the population is, I don't know, maybe up to 90, 100 million. It's a massive country, and hardly ever in the news, certainly not in the financial markets news since the default. I don't know if anybody wants to say anything specifically about Ethiopia, but we'll pass on if nobody does.
Well, Christopher, the number is about 130 million, but maybe I'll refer to Saad.
No, thanks. And I just wanted to kind of take this opportunity to just throw a few numbers, because I did a little bit of read about it. It's about over 1.1 trillion in outstanding debt. Now, this is all debt owned by governments, right? Now, 67% of that is owned by 10 of the countries in Africa, including Egypt, South Africa, Nigeria, and Morocco. As you can appreciate, these are the larger firms. But what is chilling is about $95 billion of payments are due by these governments in just 2026 for debt servicing. That's a huge amount of dollar burden or foreign currency burden on economies that are otherwise importing economies. So I know Christopher, you'll pick up this mantle about kind of sovereign kind of ability to service debt, but this is where the local market, I feel, can play a significant role. The local markets are relatively less developed, less penetrated, and rather than going and doing external borrowing, maybe the local pension funds, etc., can be bigger players. Now, granted, they are already buying about 60 to 70% of their balance sheets as government paper. So maybe the appetite's not there. But I think these are all kind of areas that you will splosh around in this conversation. But I thought, because I did the work, I didn't want to let it go to waste.
Well done. Full marks for your homework. But obviously the thing you've just described or advised or proposed has a significant currency risk. I mean, you're financing hard currency coupon payments using local currency.
Exactly. And that's my point. That's why you go to local markets to avoid that. Now, for import-dependent nations, you're already in a fiscal kind of conundrum where you can't meet your own imports and you need to borrow. Then you borrow in dollars, which is going to be an adverse kind of input into your balance sheet. So I think some countries need to take a pause and look at alternatives. I'll give you an example. I was shocked to see DRC contemplating a Eurobond issuance in 2026. They don't need the dollars for input, but still they're going for 9-10% dollar Eurobond issuance in dollars. Now, it's baffling as to why they do that. Maybe it's market penetration, maybe it's being more available to the market, or maybe known to the market. And maybe Gatsin, you can help with those concepts, but sometimes those types of things baffle me. I think there are alternatives better placed for governments to tap into.
Okay, good. Thank you.
Let me react to it.
Benjamin, I was absolutely coming to you next, and I'm conscious that rather ungallantly I've left Nicole till last, but there will be a reason for that, as Nicole will find out in a moment. But Benjamin, so debt servicing, you analyze sovereign risk. Is debt servicing a major part of the risk profile of some of the countries you look at?
Yes, thank you, Christopher, and good afternoon to everyone. So, yes, debt servicing is a major part of the risk profile of countries. I mean, if you look at standard country risk or sovereign risk analysis, it plays a key component in addition to debt sustainability in general. But I wanted just to go back a bit on some of the broader issues that have been talked about. The narrative is generally positive, and I mean, to a large extent, I guess the story from 10, 20 years ago still holds. But I think we need to acknowledge the fact that the environment has also changed relative to when this narrative started. I mean, if you look at debt levels at the time of the narrative, a lot of countries were coming out of starting this HIPIC MDRI debt relief programs, and so you had debt to GDP ratios about 30% or so. That rose rapidly to, I think, about 2015 to a higher level, and then with COVID, it even rose further, right? But as I think both Tadeusz and Gitian said, it's improving now, but debt vulnerabilities remain key, and we can see, I mean, there've been some incidents even last year. I mean, you can look at the ongoing issues with Senegal. So investors need to be obviously mindful of that. The other thing I'll say is the backdrop, it's favorable for quite a number of countries in terms of precious metals. There's been a booming commodity, so you still have that going on, and that's supportive of a lot of countries. And although maybe for oil-producing countries a bit more nuanced, there might be some vulnerabilities there depending on where the trajectory of the oil price goes. But on the demographic side of things, again, that's a positive thing. With the young population, with the right training, etc., brings up your capacity. You should be able to have more growth, productive growth, etc. But it also has a flip side, right? I mean, they obviously, young people also have a lot of high expectations. They expect governments to meet their needs. Since COVID, there's been rising cost of living, Russia-Ukraine conflict, inflation, and that's showing out in terms of basically socio-political developments, right? You would have noticed that in the last few years, particularly since COVID, there've probably been, quite a number of coups in some parts of Africa, something that a few years, 10 years ago, that was the reverse scenario was painted, right? That it's more democratic regimes and governance is improving. But because of the pressures, right, there's a popular uprising if needs are not met. Well, that's how it turns out. So just to point out that, obviously investors in Africa, there are lots of positive things, but you have to, wherever you position yourself, you obviously have to take account of some of these risks and see the extent to which you can mitigate them, because there are risks. There are lots of positive things, but there are also risks, and they need to be mitigated. Thanks.
No, great stuff. And that domestic political instability in some countries, which you just referred to, coups and so forth, I mean, that's what obviously we grew up with as part of the African scene in the 60s and the 70s. But we aren't going back to that, are we? I mean, are you optimistic that we are not?
I'm optimistic, isn't it? I think it's, to some extent, it depends upon how governments calibrate in response to demands, etc. I think some countries, there could have been potential for things to get worse, but the governments sort of adjust last year. I don't want to mention countries' names. They sort of recalibrated and tried to meet, some demands or readjust things. But sociopolitical issues are difficult. They're difficult to pin down. Right now with the age of social media, etc. Right, things can just change quickly. But as long as governments, I think, place the interest of the populace at heart and try to, address their policies towards meeting the needs, then I think the risks go down. Obviously, the institutions of the countries matter, right? The nature of, let's say, the political dynamics of the country can also affect, the likelihood of an uprising or not, right? So investors need to analyze all those kind of scenarios in making their decisions.
And Masood, just quickly with you before we turn at last to Nicole, who's been very patient. Benjamin mentioned COVID a couple of times. One thing we haven't discussed so far, of course, is COVID feels a long time ago, at least it does to me, but of course, many countries all over the world, by no means only in Africa, still have the overhang, the burden of fiscal expansion that took place during COVID in order to mitigate its effects. How serious a thing is that for African countries?
Well, Christopher, I think most people who recall what was happening in that time will remember that Africa actually largely did not go into the kind of fiscal stimulus that the industrialized countries went through. There were, of course, increase in deficits. Fiscal deficits did creep up a little bit, but it was nothing compared to what we saw in the developed countries. So the overhang is quite limited, actually. I think South Africa was probably one of the cases where there was quite a bit of fiscal interventions that took place, but they now have a surplus in their budget, and they've had positive ratings actions on their macros. So,
yeah.
So no, I think the continent was quite disciplined, and the resilience came through in other ways. And thank heavens that's not a big sort of bad inheritance, so to speak.
Good. Okay, Tabo, you would agree with that? Just really quickly, SA has a little bit of overhang, but nothing unmanageable.
Yeah, 100%. Just again to throw in one or two numbers there. I think before COVID, just before COVID, I think we're like in the 60% range now, firmly in the 70s. So a little bit of an increase in terms of debt to GDP, but nothing crazy.
Okay, good. Now, Nicole, first of all, do take a moment or two, because many people will not know about the ALSF, to describe to us what it does. I know that you are all lawyers. You are a lawyer yourself by background and profession. And you advise sovereigns, you advise sovereign wealth funds on things like geopolitics and ratings, all the topics that we're going to talk about. So tell us a little bit about that. And then the reason I've left you till last is that you are, of course, an American, proudly so. And the next big topic, which we can't avoid, is the geopolitical tensions, volatility, and a kind of disorder which seems to arise from America. I think that's a little bit unfair. You can't just sum all of this global phenomenon up with the name of one man. Nonetheless, he's kind of symbolic of a lot of things that are going on in the world at large. So the easy part is tell us a little bit about the ALSF, and then let's talk a bit more generally about geopolitical tensions globally.
Sure. Okay, so easy part, and thank you of course, for having me, us, and for the question, and especially the easy question. So the African Legal Support Facility, you've actually done a good job of describing it, but we're an international organization. We're hosted by the African Development Bank. We were created by the African Development Bank. And effectively, we act as in-house counsel, and I would say trainers to African governments in various sectors, including, of course, sovereign finance. In the sovereign finance sector, which I head, we do, as you mentioned, quite a lot of work with sovereign wealth funds, but more broadly with governments on kind of debt-related new issuances, a lot around debt restructuring, liability management exercises, and so on. So I'm glad you also brought that up, because that also puts into context where I sit in this conversation. I'm not a financial advisor or a finance person per se. I'm a lawyer, so everything I say will come from that perspective. Your question, yes, I'm American. Your question on geopolitics is an interesting one. I would say that geopolitics has always and will always have an impact in our line of work at African debt dynamics. And of course, shifts in geopolitical landscape will shape the availability of financing. Obviously, we're seeing right now a decline in ODA. It affects pricing, it affects who is lent money, who countries want to borrow from and can borrow from, and then for what purposes, of course. It's important to also keep in mind that it has an impact on debt restructurings. This is a lot of what we followed last year around different debt restructurings on the continent, in particular those within the common framework. And there we've seen a significant impact from geopolitics on those processes, both bilaterally and within, multilateral development banks as well, how those restructurings go. So hopefully we're seeing a little bit of a decrease in the problems when it comes to debt restructuring as people get sensitized to the process, and how we do things is somewhat more normalized and accepted, but that is definitely a challenge. So maybe I can stop there. You can see I kind of avoided the US specific question.
That's fine. But
Yeah.
anything that's to do with the US or President Trump is equally and oppositely to do with China.
Yeah.
And China, of course, has for a generation had a huge influence all across Africa. I was reading just yesterday about there's a huge iron ore mine coming on stream in Guinea-Conakry, I think it is, which is owned by the Chinese government, essentially. So the Chinese can import iron ore as much as they like without going anywhere near Australia, for example. Now that is really quite a big shift in the global picture. So without necessarily explicitly addressing that, how do you see China's role in Africa? Benevolent shareholder or something a bit more than that?
Yeah, no, I'm glad you asked the question. I think, let me answer the question before putting the context. The short answer is that I think that China is viewed as a key partner for African countries, period. There's a lot of, in my opinion, scapegoating of China as a lender and questioning their intentions when they enter into lending transactions with African, or any transaction with African countries. But I think it's also important to bear in mind that any country, any entity that does business with anyone has a particular interest in mind. I mean, you were talking about what you read. I read recently that now there's been an increase in debt servicing payments going to China as opposed to new inflows for financing. So that's obviously that's a suboptimal situation. But I would say by and large, that China is still viewed as a key partner in development. We talked a little bit about infrastructure, for example, which is obviously a key need. And that's, China can be and has been a key partner in that respect as well.
Okay, thank you. Nicely negotiated. Navigated, perhaps. Gatian, let me turn to you on the, obviously Rothschilds is a global firm in a very fundamental sense. You look at the whole world in more detail than any of us as simple private citizens do. What are you seeing? What's the direction? I realize this is like asking you if it will rain a week on Wednesday, a highly unpredictable and volatile world that we are in. But what are the geopolitical stresses and strains that worry you most, and especially as they relate to Africa? Is it to do with China? Is it to do with something else? Tell us what's on your mind.
Look, I think indeed maybe to start by Saad's point earlier, which I think is an interesting and important one in his question on DRC. I think there is one interesting trend which is likely to happen in 2026, which is the return of inaugural issuers on the continent, which at sovereign level we haven't seen for half a decade at least, with DRC indeed being part of that list. And I think that goes to the fundamental question as to how do you ensure countries with substantial financing needs over the next 5 to 10 years to actually meet those needs and not to be completely saturating the domestic markets and being able to progressively reach longer tenors. I think as in any inaugural issuance, there will be some element of price discovery and discovery of peers. Having said that, I don't agree on the close to 10% level which you mentioned. And I think that the fundamentals in DRC allow for a starting point which would position it closer to other sovereigns which are more in the 8 to 9% category, even though obviously all of this is very fluid, and that's where it echoes your question, Christopher, around how markets have evolved and can evolve in the future. But I think fundamentally, the return of new issuers on the market is something which should be viewed as an interesting trend also more broadly, and trying to go beyond the usual handful or two handful of sovereigns which are regular issuers and which have built over the past 10 years very regular and very deep market presence. I think for 2026, the start of the year has been absolutely amazing in terms of issuance broadly for emerging markets and specifically for Africa. But what we saw in the past 2 years is that there were clear market windows opening and closing, and indeed, with a number of external events, and you mentioned the US, being able to close up a window for a number of weeks. And even though the volatility levels and the specifically the VIX remains relatively low in the start of the year, a restart of peaks and a restart of closed window for weeks is something that can happen at any time.
Okay. One of the notable transactions, of course, this year was from the African Development Bank, although Benjamin's not on the funding side. We'll come back to geopolitics, by the way. So all of you, I'm sure Saad is bursting to tell us his views about President Trump. We'll come back to that. But just as a little sidebar on bond markets, Benjamin, it's not your part of the bank, but do just give us a brief comment on this transaction. I mean, it was $1 billion 10-year deal with a record order book. I don't just have the figure to hand, but it was multiple times oversubscribed. Were your colleagues in Treasury pleased?
Yes, our colleagues in Treasury are always pleased, when there's a good issuance. But I think, as I said, I don't really want to speak so much about that because that's not my area. But the bank has an investor base, built up this investor relationship for decades, and it always tries to engage actively with them so it can fund, even in crisis conditions, COVID, etc. It can still fund. So that's something, that Treasury Department deals with, and they try to keep investors, basically on track. Is we're AAA institution, and I guess in that sense, it's not affected by necessarily what's happening. Maybe what's happening directly in Africa or in emerging markets, etc. We're AAA institution with other supranationals like the World Bank or Asian Development Bank, so that's a different kind of investor base, and I think they are there through the times. As long as I guess they can see that you're trying to maintain your risk profile, be prudent in how you're managing your risk, etc. I think that's there are no concerns there. Yeah, so they were pleased with it. Thank you. Yeah.
It was notable in that it was the most oversubscribed issue ever, I think. So it's clearly some things. It's not just the long history of the African Development Bank's sound economic management. It's showing a greater interest. Now, Kola, I'm going to turn to you. Unfortunately, Patience from the Nigerian Debt Management Office has not joined us. But I'm going to ask you as a representative of the Nigerian state. Another very notable, not this year, but in November, another very notable Eurobond transaction out of Africa was Nigeria's sovereign issue, 2.25 billion in November, 13 billion order book. That happened in the same week, or at least within a few days, of President Trump. We'll count the number of times we say the word Trump during this conversation. That happened within a matter of days of President Trump saying he was going to invade Nigeria. Now, I don't think anybody really took that quite seriously, but obviously there were bombardments from the air. How effective, whether they hit the desired targets, perhaps we'll find out eventually. But doesn't that say something for the strength, well, the strength of purpose and mind of Patience and her team, but also the strength of the Nigerian investment story? That, I mean, normally countries that are under threat of invasion by foreign power are not going out and talking to bond investors. You remember that? Very clearly.
And we were very, very surprised by the announcement by the US president. But by the side, I think the investment community has engaged the Nigerian state for quite a while. There was a very strong demand. A lot of global macro factors were in our favor, aside from a few that were not. They actually gave the government the chance to tap the market again. I think the local demand is actually very strong as well. And also, the international demand was quite high. And so even though I still think the pricing was a bit expensive, but the government was able to issue that paper comfortably. There is no the plans to go to the market. I'm not sure what I won't speak for the debt management office, but I don't think there's any need for them to go to the market anytime soon. They might do that though, just because it can be significantly cheaper to finance in US dollars than it is in Nigerian naira, which goes back to Saad's point earlier. I believe Saad spoke about Congo trying to have a dollar Eurobond issuance, sometimes just that much more cheaper than the cost of the local yield curve. And so,
sorry, carry on.
No. So I think that's it on Nigeria's story, but there's strong investor demand both for Nigerian fixed income and also for the Nigerian equity space as well. The foreign investors are streaming back in droves to the Nigerian equity markets, and so I think 2025 was a very strong year for investors into the Nigerian equity markets as well.
Thank you, Kola. Saad, did you buy the Nigerian bond, by the way? The November?
Well, I think the traders did. There was some interest from our side. We are big holders of both dollar denominated and local currency in Nigeria. Our four largest positions are Nigeria, Egypt, South Africa, and Kenya. So yeah, we are big kind of operators.
And would you be a buyer of DRC at 8?
I'd be surprised if it gets issued at 8.
That's Getty's prediction, and he knows what he's talking about.
I know, yeah.
8 to 9, to be fair.
Yes, and I am closer to the upper range. I think there is a risk element that DRC carries, and this is the first time they're coming in the market for a long time. So all of those kind of factors need to feed in. I think DRC would be a little bit of a wait and see for us. I don't think we'll jump in straight the same way Ghana and Zambia were a little bit. We were a little bit skeptical on that. Uganda, however, looks very interesting, and they came to market quite recently as well. So I think there are a number of players that would continue to issue both dollar denominated. My point earlier, and I think I've been pulverized for it. I think the point to make there is the currency devaluation happens in step changes. We saw how much Ghana cedi fell, the Zambian kwacha, and the naira, of course. But the naira has bounced back. So I think it's about timing. People are seeing the bounce back and anticipate that to continue. However, there is one inherent risk within the Nigerian economy, and maybe I'm the cynic with a glass half full. But the forbearance that you guys talked about in the COVID-19 kind of risk that the banks carry, that still hasn't materialized in Nigeria. So the central bank wants to do away with forbearance, but the banks are like, oh, hang on, the moment you do that, we have big write-offs. And if we do that, then we've got to go raise more capital. And already capital raising has been tough, especially AT1 issuances. So how do we deal with that? So I think there is a lot of dialogue as you go layers below the financial system, and all of that has to be contextualized. So I remain a very, very kind of positive view that some of the issuances will work, but also bear in mind we have a short position that we can do at the hedge fund. So we do our returns are reflective of both long and short kind of plays that we make on the continent. So we have to be wary of both.
Okay, we've got so many topics now kind of pending and up in the air, trying to keep all these plates spinning at once. And I'm going to come to, we've got a question from Nick Durant, who's advisor to the Rwandan Ministry of Finance, and I'm going to ask him to say something. Sophie, can we have Nick on live? Think about that. Before that, Saad, I definitely want to hear what you think about Trumpery, because I'm 100% certain you have a strong opinion. But before we do that, Tabo, how does the global geopolitical situation look from SA?
I was almost tempted to share our overs and unders as well, just after following again from Saad's lead there.
Oh dear.
Yeah. Safe to say, largely agree with the picture. We're obviously liking, and apologies, I'll definitely get to the global politics, so the geopolitics in a second, but liking Ivory Coast and also looking at that Benin issue. So interest to us, and mostly like everyone else, cautious and about Kenya. So that's something else that I know my portfolio management team is kind of just looking at for as they kind of navigate that IMF story of theirs. Geopolitics is an interesting one, right? The main thing I think to say is that there's obviously a big theme of interest rates coming down globally, so that's obviously affecting all markets, and I'm sure we'll talk about that momentarily. And obviously this year, last year the picture had been trade policy. This year out of the US, the picture is obviously foreign policy, and so that's an interesting one. And markets are behaving in a very strange way. And again, as we all experiencing, typically in the past, kind of all kind of risk off action would typically mean, so all kind of high volatility action would mean that would mean risk off, and so markets in Africa, emerging markets, etc., wouldn't do as well as they've done. But obviously there's a bit of a big change in that one. Bond markets are doing well, equity markets are doing well, and that in an environment of high volatility. So very interesting take out of that, and that probably points to a structural shift more than anything else, actually. I don't want to pin it down on dollarization, but I do want to say that there seems to be some sort of weakening, I think, of dollars positioning, and so we are seeing that play out in portfolios. With the move of greater volatility, meaning that emerging markets, frontier markets do well. So that's probably my market take on it. I'm not directly hitting on the geopolitical themes themselves, but saying how does it impact markets, and so we then have to kind of remain in a sense well diversified. I think that's probably the way to play it, because currency has done well in a few regions that have been mentioned. So I just talked about Nigeria bouncing back strongly. The South African rand has done quite well as well. How do you manage, levels of dollar weakness at this level? Do you continue to believe that that's going to continue, or, how do you play that? And so we just remain a little bit sanguine about it and think to ourselves, let's just diversify our bets on this one, and not punt too strongly. It's in our minds a lot easier to talk about, when the dollar's doing exceptionally strong, and rand and other regions' currencies are oversold. So that's a much easier conversation to have. This is an interesting one. It's kind of, is it going to be cyclical? Is it actually pervasive and structural? Is just the question that's on our mind.
And that your comment about risk off segues perfectly into, well, I'm not sure if we can bring him into the conversation, but as I said, Nick from Kigali is put a comment in the chat where he says, one concern that current market exuberance tempts issuers to borrow more than they can sustainably take on. Now that sort of loops back a bit to Saad's point about DRC, but Getian, let's come back to you. Whatever
indeed, to react to Nick's point, I think fully agreed on the fact that sustainability, and that's why I was starting there earlier in the panel, at the end of the day matters a lot, and that we are still in a context of high yield environments, even though spreads are lower than a couple of years ago. Reality is that indeed a number of countries are borrowing at close to 10%. I think we also Cameron's private placement yesterday, we saw a number of transactions above 10% level last year, and those raise questions around whether from a fiscal perspective it is sustainable for countries to be having double-digit rates, and whether this can allow to have enough revenues to, in the long term and in the medium term, be able to pay off those interests, and for those Eurobonds, private placements, loans, I think independently of the format, be able to generate enough return for the country, and therefore enough growth in the revenue base to make it worth it. And to me, that's at the end of the day the fundamental question around any of those transactions, which in turn raises the question on use of proceeds and whether those are actually used to bridge short-term liquidity gaps, short-term deficits, or whether they're used to invest and to, at the end of the day, generate some return for the economies.
Thanks, Getian. And Nicole, I'll turn to you deliberately as a non-financial specialist, although I'm sure you know more about it than nearly everybody else. Whatever sort of new alarm takes hold of the world and seizes the headlines, financial markets just seem to shrug it off. I mean, as Tabo has just said, one would expect there to be a general risk-off feeling among institutional investors. The counterpoint, of course, is that gold has absolutely gone through the roof. We might have a chat about that. Obviously, we have some gold-producing countries in Africa, apart from anything else. But Nicole, what is your take on why financial markets are just rolling with every punch, seemingly no impact? I mean, the S&P is at a P of 40 odd.
Sorry. Okay. So thanks for the question. And I'm probably going to hedge a bit here to say two things. One is that that's a good question for Saad. The other one is to say that our role is actually to help governments to respond to whatever the markets are doing. So we're not market predictors, we're market reactors, and we're lawyers, we're trainers. So the idea for us is whatever's happening in the market to help the sovereign navigate that in particular. And going back to Gaetan's point around debt sustainability, that's actually a huge part of our work around debt management, effective debt management tools, and making sure that before countries borrow, regardless of whether interest rates are coming down and it's a better time to borrow or not, it's actually going to be appropriate for them for the long term, as opposed to just reacting to what's happening to the market. So I'm going to leave it there for now and let Saad answer the question on my behalf.
Okay, well, we would before Saad dives in, Benjamin, you're not a kind of investor, but you survey the investment scene. I've no doubt you have personal investments of your own, but just as a kind of economically literate observer of world affairs, how can it be that markets are through the sky when there's so much disorder in the world?
Okay, thanks, Christopher. So I mean, well, I don't think we use the term investors, but I mean, we obviously lend to countries. So I guess our interests are kind of aligned. I mean, one thing I forgot to mention, basically we have $35 billion approximately book, of which about 31 billion is sovereigns and about 4 billion is non-sovereigns, right? But we don't lend to all countries on the continent. I mean, we lend to some. I mean, we've got another arm called the African Development Fund, which provides funding for weak, sort of less creditworthy countries, which I think is about 20 billion or so. But just giving a general view on that, I think it partly reflects the fact that a lot of some of the volatility that's arising is obviously partly due to the new U.S. administration, right, and announcements, policies that are made. But I think at the same time, investors are aware that announcements can be made, but then there can be negotiations afterwards and discussions afterward. And so what seems to maybe be an initially extreme position comes somewhere in the middle. And so after things like that happen, well, I guess investors just look ahead and just say, well, look, we're going to try and manage through this. Okay, they might hedge maybe certain positions, but they're going to try and look through this. So I take it from that point of view. But then I think, I mean, this is just a personal opinion. I also think investors maybe who went through the COVID pandemic, right, and have seen effectively economies bounce back, albeit, with some shocks moderately, etc. I think if you've gone through that and you survived, you somehow survived, your position survived, etc., then yeah, you should. I mean, what's happening now is not as bad as COVID, right? When you went through COVID. So you should be able to do. Of course, the backdrop of that is also the new U.S. administration, I mean, I think has a view, I think on balance towards neutral to lower interest rates, which is more supportive for, for us, equities, etc. That's supportive for it. So I think that's, those, and also, I guess, because of the potential inflationary risks from that, if you look at commodities, particularly precious metals as well, that's leading. If you talk about gold, etc., that's a natural hedge. If you're concerned about inflation, that's where you're going to hedge. So that's part of what's driving, obviously, the record rise in gold price, particularly over this year, not just this year, last couple of years, but particularly this year has been very significant.
Yeah, and that's an interesting idea that COVID as a global phenomenon inoculated us against crises in a way perhaps a lot more effectively than the so-called COVID vaccines inoculated us against COVID. Saad, bursting to speak. Just before you do, though, have you gone long gold?
Well, personally, maybe not as a position within the fund, because we might use it as a counterbalance, as a hedge, but I don't think that's the case at the moment.
So you want geopolitics, and then how do you square what's happening in markets with what's happening in the real world?
Absolutely, as you said earlier, so many plates spinning at the moment. My head's spinning now. So, but yeah, I really wanted to share a few things. I think I don't like the word Goldilocks situation, but we find ourselves in somewhat of a Goldilocks situation where the risk and volatility is beyond any means reasonable. So very high risk levels. On the flip side, you've got markets going through the roof, and that is predominantly being triggered by this AI movement and technological kind of thesis that we are going to drive and require energy infrastructure that is second to none, and that the world has not seen for centuries in terms of development, will require cooling systems, etc. The NVIDIA platform, as you can imagine, whoever invested in it 4 years ago, and I used to have laptops with NVIDIA because I used to be a gaming fanatic, but never bought the shares, and lo and behold, kicking myself. But the thought process behind all that is going on brings investors to the fore, because this drive to, or this frenzy around precious metals also opens another box of investment. This Venezuela situation where you're going and building out the entire oil refinery system, and this systems require not only upgrades but pipeline development, which is billions and billions of dollars. So there is so much investment, so much kind of opportunity stemming through that the markets just are seeing beyond the risk. They're not even evaluating the risk because they're saying there's so much opportunity. They're really looking at opportunities as though a private equity investor would go in and say, hey, what's the upside? And forget about the downside, right? We'll have a buyer later on that will consider the downside. So I think that it's a bit of a Goldilocks environment. On the other side, you've got Donald Trump pushing down on rates, which is great for emerging markets like Africa. But on the flip side, the monetary policy is under huge pressure from not being disassociated from government. Jerome Powell is kind of on his neck's on the chopping board, if I can say that. And crude as it may be, unfortunately, the independence of the Fed is on the line here. So it's a very fine line, but a Goldilocks environment nonetheless, because you do see risk assets that do hedge otherwise inflated risks like gold through the roof, silver through the roof, copper really kind of doing well. So the commodities have had a phenomenal year and they will continue, I reckon, to do so. Yet the inflated levels of borrowing. So will this Goldilocks environment continue is where, again, my cynicism comes in. I don't see that continuing for years and years. So what is that crash environment looking like? Jamie Dimon has also said that this kind of insular looking view of the US is not what he foresees as beneficial for the US. So all of these things kind of pulling each other apart, and yet the money is flooding in the market. There's also a lot of liquidity sloshing around, so that has to go to work post-COVID, but also people have generated significant returns and they need to put it to work. So yes, a mind-boggling environment, but I think the next 4 or 5 years look very promising for Africa for a number of reasons. One, on the public markets, yes, you've got access, and access has been the predominant factor of countries not being able to raise money. But the key question for them is, will this market access continue? And that's Gattian's cup of tea, right? So, and I won't tread on his toes for sake of my dear life. But also on the flip side, you've got markets deepening within Africa. You've got the private credit environment developing where there's significant capital sourcing SME and mid-market opportunities that otherwise didn't have capital to expand, which is a phenomenal environment to be in. So Thabo mentioned his exposure, and that's where our paths have crossed, where they're also contemplating how they can help develop the African continent for their benefit as well, right? So if the countries around South Africa struggle, South Africa, by virtue of just being neighbors, cannot thrive independently. They have to thrive in the environment. You've now also, on the left of or west of South Africa, got this development of the Lobito corridor by the US for access to minerals and all of that, which is huge infrastructure development. So all of these kind of aspects and players and things happening, phenomenal for the continent, great from a capital perspective. I think long term, we've got to be mindful on Eurobonds. I think the only downside is for low or less strong governance, the use of funds can be anything. And we saw what Ghana went through because of ineffective use of capital that they raised without them being used for capital generation. What is imperative is if you raise Eurobonds, if you raise foreign currency, you've got to generate whatever you need to repay that. So having that foresight that for the next 10, 15 years, infrastructure development for foreign currency is required, without that, you'll see in a few years the story kind of coming down as a house of cards. So that's my fear, but very promising.
Okay, promising but falling over. Okay. You're not an economist, are you, on the one hand and on the other? Just the sort of the word from off stage, the participant who's not with us, Nick, from the Rwanda Ministry of Finance, he's put in a suggestion to explain question we've just been discussing. Markets continue to be the battleground for the animal spirits of fear and greed is holding sway. So that's the view from Nick in Kigali. Several of you nodding. Gatien, back to you for a moment on and then we've got to sort of going to have a bit of a pause because we're just over halfway through to go into some back to specifics of fixed income, because we've got 2 or 3 questions coming in from people in the world outside, and I've got some questions as well, and then we'll take on the domestic markets question. But Gatien, just before we go back into bonds, do you have anything to add on what Nick calls the animal spirits, keeping markets afloat when all around is sinking?
Look, I wouldn't dare react to something framed that way by Nick. So I leave it to his comments.
Oh, all right. Okay, that's very brief. In private meetings, people must ask you this all the time. People possibly occasionally ask you about the political situation in France. But we shan't talk about that, even though it made you smile.
And then the glasses, the share price after that company skyrocketed 60%. I think I'm going to buy myself one of those as well. And Christopher, if you allow me, I think one kind of aspect of praise to Nick on the other side is Rwanda has done phenomenally well when it comes to not only local development but also global access. I know there are geopolitical kind of tensions there as well, and Tabo's on the course, so we'll stay very, very clear of that. But the aspect that I want to talk about, the pension fund RSSB has been very, very active, both developing the local market in terms of access to commercial papers for businesses, but also launching an SME fund which helps businesses access get access to capital. I think those type of strategies, if African governments come together and evolve those strategies and build them out, and obviously South Africa is the front runner on that, they've done a phenomenal job. I think that's a very positive sign for the African continent. Build from inside as you continue your market access externally. But just a point to Nick as to what the finance sector in Rwanda has done, but also the government.
Okay, thanks. Now, as I said,
I'm jumping in for a sec. Sorry, apologies. Just to put in a thing and maybe add to the conversation.
Yeah.
Just actually something that was mentioned a lot earlier, just when we were kind of brushing past gold. Just a kind of a slight change we're seeing in terms of institutional investors in SA, but I suspect this actually might be something that's broader than South Africa. Our kind of regulation and setup in general are not pushing pension funds to invest directly in commodities, and so almost no pension funds will have that exposure directly through TFs or any other measures except through the underlying counters. Our thoughts have just been that maybe we should relook at that. That's kind of almost been the structural change. Is this has that traditionally been the right answer, or should we change that to actually invest directly in the commodities themselves? So I'm just throwing it out there that's just something that we having to do a little bit of homework on, and more than likely actually will potentially pursue that directly. But that is, as I said, like a fundamental shift. Most pension funds haven't quite looked at in that way.
Although there's a conceptual argument, of course, to say that whilst gold is a commodity in the sense that you dig it out of the ground, it's not a commodity overwhelmingly. Obviously, it does have some industrial applications.
Yeah.
It's not a commodity in the same sense as copper.
No, absolutely. And so we well aware of that. But it is still a question of whether, now to talk about fear and greed, that fear will win out and gold will continue running. That's really still the question. And as I said, I actually like the framing of thinking about it as, is it a cyclical thing? Is it short-lived? Or, is there something more structural going on where we should potentially invest in, things like gold for its hedging purposes, and potentially even Africa, fixed income, etc.
And Christopher, if you allow me, one thing that I would say to Thabo is what has to be looked at for a geography like or country like Botswana is diversification, right? We've seen how they've now really kind of lost the battle with diamonds kind kind of being less of a commodity and more of a problematic asset. So for them to diversify in such short order is going to be challenging. So diversification should always be front of mind, I think, for all geographies. So I think kudos to you guys for thinking outside the box.
If I had a question ready for Seti Balang, if she joined us from Botswana, that there was a little joke about them having the hardest currency of all hard currencies, but sadly, well, I managed to get it out anyway, didn't I? I mean, but gold, Taba, has all of the characteristics you just described, but of course it also has a kind of visceral, emotional appeal. You know, it's such a nice thing to pick up and touch and hold, and so yeah. But it's interesting that you think there could be a change in strategy on the way. Now, Admaster, you disappeared from view for several minutes now, but I guess you're still there. Ah, you are still. So you've been listening, I'm sure. I promise I will turn to the questions that are coming in from the outside world in a second. But you've been listening to what everybody else has been saying. Have you anything to add, whether on the question of markets being counter-cyclical to geopolitical disorder, or any of the other topics raised in the last round of questions?
I think the color of the conversation has been reflected quite well. There's of course many elements in the spectrum, and nobody can sum it up easily. So I think the touch points have been covered. Not much more to add.
Okay, well, I'll stick with you then in that case, because one of the questions that's come in is about sukuks. And I know that the Trade and Development Bank has issued sukuks, and this might lead to a couple of comments from each of you about investor appetite from the Middle East, and the Middle East in terms of an investor diversification play. Not that they haven't been in Africa for a long time, of course, but sorry, I'm just scrolling down. The screen is rather far away for me to read, so apologies for zooming in at you all. Yes, I'm not sure who Colleen is, but Colleen has asked us on sukuks, a number of African sovereigns have said they may issue one this year. What is making sukuk more appealing for African sovereigns right now? Well, you're not a sovereign, of course, Amasa, but you're an SSA. Answer Colleen's question.
Yeah, well, Christopher, I think it has to do with the healthy diversification that most issuers are looking for. It goes beyond the sukuk money center. Sovereigns are also looking at the samurai markets. They're looking at the panda bond markets, the dim sum markets. Of course, we talked about domestic liabilities. That's also been a big growth area since COVID for most African countries. So what sukuks are important, and that, of course, it speaks to a particular money center that has a great deal of liquidity to offer. And I think the perspectives out of the Gulf have changed. I think there's a lot more appetite to provide funding to emerging markets, in particular Africa. And so there is that kind of underlying shift. It has to do with other shifts as well, which is more about taking more interest in the nearby jurisdictions, whether it's from an agriculture perspective or just a nearshoring perspective. Many different issues around security and diversifying investments. So the sukuk angle really speaks to a number of those considerations.
Okay, and just one other comment coming. Cedric Mbeng, who I think may be a colleague of yours, Benjamin, from the bank. Not sure about that. He posts that Kenya has publicly expressed interest in panda bonds, as Amasa was just saying, and so has Uganda. So we talked a little bit about what he calls the reprofiling of policy effort vis-a-vis China. If anybody wants to pick that up, please do. But so sukuks and this, an anonymous point come in. This connects us perfectly with a big question that we've mentioned once or twice, but we definitely want to go into in more detail. The anonymous poster says the domestic markets may help reduce pressure on external finance, as we've already been saying. do you consider crowding out of the private sector in this market a factor in economic growth? Now, that's a very interesting angle to take. Just before I ask some of you to comment on that, may I just ask Ben, I should know this, but I can't remember. Does the African Development Bank have a sort of IFC equivalent as some of the other regional multilaterals do?
No, well, we have, I think I explained before that the bank's portfolio consists of sovereign and non-sovereign. So
yeah,
that's within the African Development Bank. I mean, there's no separate entity that is focused on private sector operations. Yeah.
Okay, fine, good. Thank you for clearing that up. Apologies for my not knowing it. So that topic from Anonymous is rather a good one. Nicole, let's come to you because you advise sovereigns on funding. If sovereigns are increasingly going to tap a local investor base, and we should also talk a little bit about how that investor base is growing and what the structure of it is and how it's served by local asset management funds. But if sovereigns are going to do that in order to minimize hard currency borrowing or exposure to hard currency, isn't there a risk that local investors will put their savings into government bonds rather than investing in more productive instruments, if I could say that?
Yeah, no, thanks for calling on me. I actually wanted to come in also on the Sukuk point because we work with, obviously we work with a lot of different African sovereigns across the continent. And what we've seen, is just to kind of repeat actually what Masu said, is that there's a real interest in diversifying and looking to other potential lenders to, again, a lot of, it's a lot about financing infrastructure, but of course for other reasons as well. And so we've seen a lot of countries coming to us asking for strategies in that respect, trying to understand better how these work and, who are the players in the market. So I just want to emphasize that that's actually a big area of interest for the countries that we support.
And just a PS on that comment from you. Again, Nick is saying how he was a former investment banker, so he recalls doing the South African Sukuk in 2014, a mitigated success in spite of investment grade. But as I think I mentioned at the top of the conversation, Benin, of course, has just done a fantastically successful Sukuk issue. And they've been a pretty smart issuer generally over recent years, with their debut was, I think, was $1 billion plain vanilla, and then they followed up with $1 billion social linked bond. Nod, Gassian, if that's true. I think it's true. He's nodding. Good. So, Nicole, back to where you were, please.
Yeah, no, I just wanted to emphasize that, and also to bring it back to the earlier conversation around geopolitics. I think that's a big link to the question. So also, domestic capital markets has been a big focus for the countries that we work with as well, in particular low-income countries that are trying to deepen their capital markets or their debt markets. And you asked about kind of the downsides of that, and there are downsides, and I think maybe this is also something that Gaetan wants to touch upon as well, but there's also that balance. We want to be careful when we develop a domestic capital market to make sure that it doesn't ultimately cause more problems than it adds values. For us, what we've seen is that a lot of the kind of lower income countries aren't quite, there's a lot of talk about entering into or improving their markets, but they're actually not quite at a stage where their enabling environment is appropriate for that. So that's actually quite a bit of the work that we do at the ALSF is around helping them to get ready. And that can be looking at financial aspects, but of course, also like the legal regulatory framework for domestic debt markets in different countries.
Okay,
so I hope I answered your question a bit. I'm a big hedger.
Well, yes, we know. Well, we've got that. I mean, the crowding out thing is a global phenomenon that people always worry about, but it's certainly worth putting on the agenda. Gaetan, you're advising African sovereigns day by day. Do you sense that the boosting of domestic capital markets is a region-wide phenomenon? Are there particular countries where there's an example of that you would highlight? And then I have a follow-up on that.
Look, maybe to pick up on Nicole's point, indeed, I think it's a permanent concern to find the right balance in the right mix in terms of financing sources and striking an equilibrium between domestic and external, and even within external sources, finding the right currency mix. And to the earlier discussion on sukuks and on Eurobonds in a wide range of currencies, I think it's obviously a very interesting and important source of diversification. Indeed, we're very proud to have assisted Benin in its latest transactions earlier last year, and I concur with Nick on the fact that this sukuk may be indeed a turning point and create more diversification in terms of formats and therefore in terms of investor base in Africa. When it comes to domestic markets, I think there is also a topic which is kind of in between external and domestic, and which is how do you attract international investors to come in domestic transactions. To that extent, I think what Ivory Coast has done last year, having a CFA bond, denominated in Ivory Coast currency, with full subscription from international investors, is something which is a model which a lot of other sovereigns are thinking about, and which is the result of years of engagement with investors. And to me, that's one of the answers to the question in terms of how do you avoid saturating your domestic market and having a crowding out effect of all the potential borrowers. And so, are there any perfect example of countries in terms of finding the right balance? I think that's a question which you can only answer in hindsight and seeing afterwards whether you had found the right mix and whether you ended up being overly penalizing for companies, or conversely relying too much on external needs and on external borrowing, and therefore risking risking currency slides on the other side. So to me, it's indeed one of the questions we're spending a lot of time on, and one of the best answers is to have much more international interest for domestic auctions. Yeah. Hopefully I answered at least part of your question, but sure, which is the very broad one.
That won't stop me asking you another one. So when we talked about domestic currency, local currency, obviously mainly we're talking about domestic markets. But there have been examples, very interesting ones. A country I follow quite closely for some reason is Paraguay, did a global local currency bond in 2024. Now, I bet 99% of financial market participants don't even know what the currency of Paraguay is, but they got this deal away. It was very, very successful. Do you see potential for more of those kinds of things coming out of Africa? I think Nigeria has done global, let's call it, global Naira bonds have been done, haven't they? But Gatia, do you see more potential for that? And Kola, I'm going to come to you next.
That's exactly what I was alluding to, mentioning Ivory Coast. I think a lot of countries are thinking about this and trying to build the right building blocks in order to get there. I think it's a journey, but it's one which is very worthy. Having said that, I think you have increased interest, but I'm sure Sad can chip in on this, increased interest from a lot of portfolio managers in putting on domestic currency and in actually going into domestic markets, which is also another way to answer the same equation and the same question.
I mean, obviously, a global issue in local currency is an ideal way in to get people into your domestic markets. Kola, I think I was right about there having been global naira issues, but please correct me if I'm not. But also your take on domestic and therefore local currency debt markets specifically in Nigeria. What is the government doing to encourage participation? Is the market attracting new types of investor? Is there for start off with, how much foreign participation is there in the local naira capital markets?
There's quite some substantial foreign participation from funds like SAD's fund, that especially after the currency was liberalized, participants in that subsector have actually made outsized returns over the past 24 months. And then there is also quite a large FPI flow for the carry trade as well. So we see a lot of that coming in, but that is short-term hard money, really. So what the government has done and what the Supras, I believe IFC had one of the first issuances by a decade or so ago, was to actually issue AAA international naira bond. I think IFC issued one of those, let's say, over a decade ago. Now, obviously, naturally, because it's a Supra, was actually priced under the sovereign. And so, it was actually that made it eligible for the kind of funds that couldn't buy the Nigerian government that was rated, BB minus at the time, to be able to purchase this kind of securities. And that actually, as you rightly said, brought in, naira inflow into the market. Has the government tapped a lot more of this? Not of recent, not substantially. Do we expect to see more? Yes, just as I said, as the currency has been liberalized now, it's actually quite easy for investors to come in and come out, and so we are seeing increased flows into this part of the market. And the other thing we are seeing as well is the pension funds, who are a lot more active, now buying into a lot more diversified paper. So when I say diversified, away from government issuances into corporates, and then recently into infrastructure paper. So, we now have long-dated infrastructure bonds in Nigeria, up to 20 years, that are project-specific. And so there's a deepening of the capital markets within the country to allow for more local sourcing, a lot more local funding of these large-scale infrastructure projects.
Okay, and my colleagues in the Digital Monetary Institute wouldn't forgive me if I didn't ask for a comment that there is a digital naira, isn't there?
There is a digital naira. That's correct. Yes.
Yeah, and has that been a successful initiative?
No, it hasn't actually. Unfortunately, it hasn't.
I'm sorry, I think I knew that. Sorry
I think they expected, but it hasn't had the success they had hoped for.
Okay, good. Well, we won't pressure any more on that. Delighted to see joining us on the screen is Nick Durant, quoted once or twice already in this conversation. Hello, sir. And that's made all of you move around the screen, so you're all in different places now. But Nick, make your point in viva voce about the distinction between currencies pegged to the euro and those not.
Thank you, Chris. Thank you indeed. And then good to join the panel. Thank you for making space on the screen. Yes, I would make a couple of distinctions when talking about the local currency markets. I think it is important to distinguish between those currencies which are pegged to the euro, which of course includes the CFA franc, and those currencies which are not, which are entirely free float, many of which are much less liquid, much harder to hedge, for example, for the international investor. And that, of course, has ramifications when one thinks about local currency global bonds. These bonds have been in existence since the mid-2000s. We would see euro-ruble bonds from corporates even as long ago as 20 years from here. So that, I think, is a very important point. And I think the good work of Rothschild and others in West Africa, I think it is foundational with what Côte d'Ivoire and others will be planning to do with regards to those pegged currencies to sit alongside the hard currency. I think the hard yards will come for those currencies which are unpegged and less liquid. Of course, whether we're talking Naira, Cedi, these are liquid currencies for all intents and purposes, and therefore those markets are available. The other thing I would say, just on the point around local currency, of course, is that it's not a panacea to the inconveniences of hard currency markets, because of course often the interest rates are higher. There'll be a full range around the continent. Not all countries have access or have developed yet long-dated local currency markets, and indeed in some countries there is a very small nexus of investors in that currency, and therefore there is real sort of moral hazard in a sense when things go awry. So I think it's a nuanced argument actually, but of course the development of those local currency markets in all of those directions will be, I think it will be very impactful on mitigating many of the concerns that we all know very well about hard currency funding.
Okay, thanks, Nick, and thanks for bringing in a little sort of contra perspective on the local market side. Thabo, South Africa obviously has highly developed domestic capital markets and financial institutions, asset management firms, banks, and all the rest of it. What is your view on further development of Rand capital markets, Rand domestic markets, principally in bonds, either government or indeed corporate? Paint us a picture of where we are today.
Sure, I think maybe the simple picture would be to say that most of South African government's issuance is in local Rand. I think by a long shot, it's not even close. And that being very positive, I think for South Africa, as obviously currency does, can be quite volatile. Not least if you kind of think about the fact that we're a proxy. The South African Rand is a proxy for emerging market currency, and so does have a lot of volatility just embedded just from the trade perspective, and so quite a stabilizing factor actually having most of your debt in local currency. I totally accept Nick's points about the fact that it's a nuanced conversation. Not least, once or twice I've spoken about Ghana and the fact that governments also can default, just as easily in foreign currency as they can sometimes in local currency, and so that again not being a panacea. So I kind of accept that point. In terms of local development of the ZAR market, very strongly developed market. I think I don't know if there's much more to say on that. The fact that that'll probably continue deepening. So just from the asset management fraternity, there's been quite a lot of development actually as the local currency, the equity market specifically continues to shrink and has been in a shrinking path for maybe 10 years now. The asset management fraternity is basically starting to look outside of South African borders to manage money potentially for even local investors in offshore markets. And so that's probably the latest kind of big move. And us as a pension fund having to think through whether we support our local asset management fraternity or do we alternatively go offshore and just invest through managers that already have a footprint in those offshore markets. So that's that kind of being kind of a bit of our thinking there. If I think just even about Africa XSA, when we ultimately invested in we were looking for a partner, an asset management partner to come across and invest in private credit. We ultimately actually went with a player that is based in South Africa, just showing you the fact that and having looked at Enco and a few others that we liked, but showing you the fact that we also do kind of want to back local skill and local asset management. But yeah, as I say, that's an evolving picture. That one, but really the trouble of play being that more and more, I think the asset management fraternity at least will start looking offshore.
Okay, and are there any changes coming in the kind of overall social security or pensions market in terms of individual contributions, corporate matching, and things of that sort? Are there some new things coming in that sphere? I mean, that's precisely
sure. Yeah, bread and butter question there. Again, like Nicole said, I'll thank you for the easy one. I don't know what's around the bend, but certainly what's happened is pension fund wide, almost like all regions really. There's been a move away from DB to DC, so that's not news, I suppose, to anyone. What's interesting in terms of local development has been that we've started thinking about, emergency access to your long-term pension fund, the capital. And so we've come with a two-part system, we call it. Ultimately, you accrue not only in a long-term pot that actually shouldn't be touched, and we're hoping that preservation actually increases as we give people no access to that pot, but also kind of an accessible pot, a short-term savings pot. So that's kind of been what we've done. I think that's an interesting innovation. Probably the other one worth talking about maybe briefly is this idea of collective, and again, thank you for the easy one, the idea of CDC, collective defined contribution funds. Again, a lot of that is kind of the developed world. I won't get into too much detail. Safe to say that I'm starting to see a little bit of talk about, thinking about evolving even DC to this idea of collective defined contribution. Again, those are the easy ones. Thank you.
Okay, good. I can't resist saying to you, as you talk about the rand, that when I first knew anything about South Africa, the rand was known as the 4-7-11 currency. Do you remember why?
No, please go for it.
4 to the Deutschmark, 7 to the dollar, 11 to the pound.
Slightly before my time. Slightly.
I'm really showing my age here. And Masu, I don't know why I come straight to you after making that comment, but give us, in terms of the bank's mission, obviously trade is part of it, but is part of it also helping to fund and advising on the reform and building of local capital markets? And tell us about that if it is, but also just tell us about what you see as the developments in domestic capital markets in your main countries.
Yeah, Christopher, we naturally have a view that the long-term agenda of the financial markets of the region involves that side of things. We're not very active in actually taking a direct advisory role on the development of capital markets. We leave that to some of our partners. FSD, Financial Sector Deepening Africa, is a specialized agency that does that. What we do is sometimes we'll invest in exchanges. So we have an equity stake in a number of exchanges, and we also try to stimulate the capital markets by doing local bond issuances. We've done that in several East African markets as a way of diversifying the issuer base within those particular jurisdictions. And they've been very well received, well subscribed. But of course, the truth remains that most of the exchanges, with the exception of maybe South Africa, a little bit of Nigeria coming up now, just quite shallow, right? So even if you went in and you wanted to do a significant issuance, you just find that there's just not enough depth in the market to absorb your paper. So we've done $25-30 million issuances, but that tends to be as big as you can go in many of these mid-sized economies, so to speak. Yeah, we do take an active interest in doing what we can.
A classic MDB activity, of course, is issuing in local currency to help establish a yield curve and simply knowledge of the existence of the currency as an investable asset.
Exactly.
And Nicole, you must advise people on precisely this question or this set of questions. Your comment on domestic capital markets, and also I'd be interested to know if any countries, to your knowledge, are preparing to launch specifically retail govies, a retail govies program. But more generally first, please.
Sorry, yes, can you hear me? Yeah, so the question is whether we advise in this area?
Yes, I mean, yeah. You do. I was assuming that you did. So.
We certainly do. And as I said before, that's an area that's picked up actually quite a bit over the last year. To my knowledge, the answer to your second question is no, not with the countries that we work with right now. The countries that we are supporting are very, I would call them more in their embryonic stages of domestic debt or capital markets development. So they're not quite yet at that stage, but that's ultimately the strategies that we put in place for them. That's the direction, but that's not where they are to date.
Okay, Benjamin, depth and sophistication of domestic capital markets, how does that play in when you're measuring country risk? Is it a factor that you would observe, would include in your analysis?
Yes, I mean, I think using the example of South Africa, I mean, fact that, yes, it might have relatively high debt levels, but most of it is domestic denominated. That provides some mitigation towards risk because, it's not reliant on foreign currency reserves to pay off its debt. Obviously, as indicated, there have been instances where, well, maybe the instance was Ghana, which defaulted on a domestic sovereign bond, which is not normally what you'd expect. But generally, I think, yes, if you have lower, basically a higher proportion of domestic debt, foreign currency debt, at least you're mitigating foreign currency risk. It's a slight twist on maybe what you're talking about is still domestic issuance. But one thing, I mean, I'm aware of that some sovereigns, or at least one sovereign, considered is having domestic dollar bonds, right? I mean, you still have the foreign currency risk, but you have, obviously, if you think of it, you're going to have certain institutions, I don't know, maybe private individuals who have lots of maybe dollars in the country, and obviously it's in a bank which will not be paying any interest rate or any coupon, it's probably just sitting in a bank. But if you are able to tap those resources, right, you're potentially going to tap it at, say you have a 9% Eurobond, right, you could have a local dollar Eurobond that maybe less than half that, just simply because the local market doesn't have the the capacity to invest the dollars it has, and it's prepared to lend.
You wouldn't get the volume, though, would you? You wouldn't get the volume.
You will not get the volume, but it's still a diversification strategy. Even if you can get 200 million out of it, well, it's still something out of a potential 1 billion bond. You have 800 in your normal Eurobond, maybe 200 in your local currency. Well, from your local investors. Thanks.
Okay, we've got a question from outside about ratings, which is we have on our agenda anyway. We've got 15 minutes left, by the way, ladies and gentlemen. So the specific question, I think, was pretty much exactly the question I put in our agenda. I can't just find it at the moment. These questions are sort of out of order. But the question basically is, do international ratings agencies, I mean, ratings are obviously an important technical aspect of global bond markets. We can all have our different opinions on their fundamental conceptual validity, but let us treat them with the seriousness which they deserve. Do the global ratings agencies get Africa? And I think what the questioner said was, doesn't Africa deserve, or shouldn't Africa have a regional-based ratings agency covering the whole region, but some African shareholders, African capital for Africa again. Who'd like to kick off on that? Side, you haven't spoken for a while. Unusually.
Benjamin, why don't you go first? I'll come second, because I'll talk about GCR and Augusto, but we need a lot more penetration. But please, over to you.
Okay. So thanks for that. Well, I mean, obviously, this topic is an issue that's become very topical, particularly over the last 2-3 years. I mean, there are various points in which you can look at this, but I mean, ultimately, I think, as you said, Christopher, a rating is an opinion, right? I mean, that's what it is. It's an opinion based on expert judgment. A series of experts have an opinion as to what essentially maybe the likelihood or probability of a default of an issuer is. Now, there are various points about this debate, but I think the point is related to the issue of the African credit rating, potential African credit rating agencies, the fact that maybe there's a perception that maybe rating agencies are treating African countries a bit harshly, etc. Now, rating agencies, particularly since the global financial crisis, I mean, they got a lot of criticism for mortgage-backed securities, also even the Greek default, bond default, etc. That the actions actually made things worse. So they've been very transparent with their methodologies. I mean, you go online, you can find exactly what you need to know about how are you as an issuer going to be assessed, right? So I think the issue here is sometimes countries need to, particularly the debt management offices in countries, need to be very familiar with those methodologies, right? They need to do a SWOT analysis essentially of themselves against those methodologies to see how do they score about it. If they really do feel that they're being penalized, then, well, they have to be able to give specific examples. But the point is that I think rating agencies are relatively objective in it. Of course, it's an it's an expert assessment, right? It's not completely scientific, right? But the point is of those methodologies is to try and make it as objective as possible. I mean, we rate countries within the bank. We rate all the 54 African countries. We also rate some about 20 non-regional exposures, both industrialized countries and non-industrial emerging market countries, right? And it's all about relative ranking, right? You're going to have objective measures. So I think it's important. The African Credit Rating Agency, you know, the point about it is if it's going to exist, it will need to build a reputation, right? Because ultimately, investors have to trust. They have to trust. I mean, you know, they use ratings. Ratings are actually not the only basis for making their decisions. I mean, yes, we might look at Moody's, S&P, and Fitch rating, but we do our own internal credit assessment, right? But they are important tools. And so you have to build up that reputation. It does, you know, it doesn't happen in building up that reputation. It takes quite a while, right? Because if you, as I said, if you look at the European global financial crisis, a lot of criticism, but if you look at the market share of rating agencies, about 90% of ratings in Europe are dominated by the three rating agencies, S&P, Moody's, Fitch, right? I mean, despite all the criticism, the next rating agency after that is like 1% or 2% market share, right? So you have to know there's a first mover advantage there. So, okay, you can have that, but, you know, will the investors accept it? That's one thing. But there's still a role for them, because maybe, yeah, they can help provide more information, help maybe countries get better awareness of where they, you know, what they need to strengthen their risk profiles, etc. So I think that's the angle from which it, you know, it needs to be looked at from, right? But I'm aware it's not a very easy topic to, you know, to discuss. I mean, the bank is rated AAA, right? So, and the bank operates in Africa. Our portfolio is essentially African. Yes, it's a financial institution, and we achieve that AAA status in combination with a portfolio, but also capital backing, etc. But it's in Africa, so rating agencies, I think, are relatively transparent. I mean, there's no specific, there's no perfection, right? So I'll leave that. Thanks.
Thank you, Nick. Oh, you've got your finger up as well. I was going to. I mean, you must be the guy in Kigali who talks most to the international ratings agencies. What's your comment on this?
Christopher, well, we have a very broad and deep dialogue across government with the agencies. But I'll say this, and I would echo some of Benjamin's points here, but I shall do so in brief, to say that there is a highly polarized debate in the public domain, which I think is a distraction, because the proposition here, at least in my mind, for what that's worth, is not that somehow this prospective African credit rating agency is to replace the big three, but to complement. There's much that the big three don't do. They don't have the resources to do. Ratings for African corporates to facilitate, enable access to funding, for example, would be a huge win for the agency. But somehow to go head to head, and I'm not sure that that's actually how the agency and those who are forming it perceive it themselves, but there is this perception somehow that this agency must respond to the big three in that almost confrontational manner. No, and I would highlight actually Benjamin's point that credibility is absolutely critical. There are rating agencies, so-called homegrown. I'm thinking of some in Asia, for example. Who in stressed moments investors have looked to, and they have looked askance, because those agencies haven't responded really very well to the deterioration of credit risk. So one must start with the investors. These agencies are for the benefit of investors so that they can assess the risk. Yeah, so lacking that credibility, it becomes an echo chamber to say that we think we're rated X or Y. So this agency will be deeply valuable, no question. But I think it's important to understand exactly what that role is that's additive to the big three.
And I remember there was quite a few years ago an attempt to establish an investor pays ratings agency. It was a US firm. I can't remember what the name of it was, but of course it crashed and burned because investors don't want to pay for anything. So, you know,
Right.
it does seem to me a kind of contradictory fundamental of the whole industry that the people who are paying are the people who potentially suffer or benefit. Anyway, we'll leave that there because we value very much our friendship relationships with ratings agencies. Nicole, you wanted to say something on this.
Yeah, I wanted to say a couple of things because we obviously on our end have ratings conversations a lot with the countries that we support, but two preliminary matters that I think are often not on the table and discussed as much as they should be, but you know, we should talk more about them are, first of all, there are things that the issuer needs to do on its end. Number one is making sure that when it's issuing debt, that that's actually an appropriate thing for it as a country to do. And that tends to be not enough as part of the conversation, I think, as it should be. The other one is that the countries themselves, as Benjamin alluded to this as well, but really need to make sure that they understand the methodologies, but understand what is being asked of them and make sure that they're able to provide the relevant information. Because a lot of times, you know, the rating agencies are going in country asking for documentation, they don't have them, etc. So there is work that needs to be done on the issuer side as well to improve the ratings outcome more generally, I would say. On the African Credit Rating Agency, I know Saad is going to say a couple of words about one in particular he mentioned, but I do think, again, that there's scope and value in a regional agency. It can't replace for the time being the big three. I think it, as Nick said, this is for investors, and it also has to be something that's credible, understood by investors, respected by investors. But I do think there's scope for it to play a complementary role. But this also ties to our discussion around domestic debt market development, right? Because as we have a better or more enhanced or deeper sub-regional capital market, then you might see an increased role for, you know, a continental rating agency in that respect. So I think those would be my two comments, except for I do have one more, sorry, just to add one more point there on the first point around whether Africa is understood by the credit rating agencies. I think perhaps not fully. And there's definitely a big move from African countries saying, okay, these credit agencies are not necessarily for us. And that's probably tied to, although it's obviously not the only reason for AfrXM's recent discontinuing of relationships with Fitch. There is a general sentiment that the rating agencies don't currently get them. But again, the rating agencies are also responding to that, trying to, on their ends, do a better job, et cetera. So there are two sides of the argument, of the discussion rather. And I think this is kind of a space to be watched.
Yeah, I mean, you need difference of opinion to make a market. Now, we've got 3 minutes left, and I want to ask each of you a load more questions. But Kola, just quickly, a comment on ratings. Would you be a big supporter of an indigenous African agency?
Definitely. I think there's a massive need for one. I think someone who's on ground, who understands the local dynamics and who sees the risks from a different lens. I think that blend would actually add a lot of value to the credit rating system we currently have.
And in Nigeria alone, of course, you would have literally dozens of both corporates and financial institutions, some of whom obviously are rated by the international agencies, but who would then be able to secure a rating on local terms.
Exactly. And the added benefit would be quite substantial.
Yeah. Saad, your comment has been postponed. We can't hear from all of you, I'm afraid, but Saad, before I leave the last word to Gatian, your comment, please, on the ratings agency question or whatever else you've heard.
No, absolutely. I think there's a much needed credit rating platform required for the African continent. The big three do not follow it through. GCR was doing a good job until Moody's took it over, and then the ownerships turned. So the same way we did with insurance and reinsurers based on the African continent, we have to think about, firstly, from the ground up, how to develop credit bureaus, consolidate that data on a very instrumental and grassroots level, consolidate that across regions, and then bring a ratings platform. That is the first and foremost priority that we should have on the African continent, because it really affects borrowers, both corporates and sovereigns. So yeah, let's do this in earnest. I think it's a much needed tool. And by the way, I love the conversation. If you wanted to comment from me, I think much needed conversation, and I hope you guys continue this on a much broader level. It's useful for all, especially folks like us who are investing on the continent and very active. So thank you, really appreciate it.
We'd absolutely be delighted to do more. As I say, it's been 2 or 3 years since we last did an African sovereigns one. I only managed to get to Latin America, my favorite part of the world, once a year. But point taken. We shall definitely try to do more. Now, Gatien, I'm going to leave the final word to you. Sum up the last 120 minutes in a minute or less.
Look, let me have a stab in one sentence, which is that it's an absolutely fascinating time to be monitoring Sub-Saharan Africa, with a lot of potential upcoming developments, which could completely change the dynamics as we highlighted over the course of these 2 hours. So I think there's still a lot to monitor, and I concur with Sad on the fact that there could be subsequent very interesting discussions in coming months.
I mean, there's loads of things we didn't get to, like MDBs generally, apart from the African Development Bank and the Trade and Development Bank. Infrastructure, can infrastructure be made an investable asset? All of those fascinating topics we shall have to leave to another day. But thank you all very much. Thabo, Nicole, Saad, Kola, Gatien, Nick, glad you could join us at partway through, and Benjamin and Masu, and of course all of you out there. I'm sorry if we didn't get to your questions or all of your questions, but do please join us. Watch out for the next session. I think we might try and do one Q4, September, in advance of the World Bank meetings. That would be a good time to do it. Anyway, if we were all in the same room, I'd be inviting the audience to clap. But as we aren't, just take the virtual applause that's going to all of you. Thank you all for being excellent panelists. And until the next time, thank you. Goodbye.
Thank you.
Thank you. Bye-bye.
Bye.